This is Chasen Booher with Prestige Partners Real Estate. I'm here with Brady Mullen of American Liberty Mortgage. We're going over a property I have currently on the market in Pueblo West. The address is 378 West Coral Drive, 81007. We've got some calculations here to kind of show a little bit about this property and the value it can bring to you as an investor or even as a owner-occupied property itself. But the property it's a very good property, very well upgraded, and can bring in some great rents, as you'll see. It does have granite countertops, 42-inch cabinets, all one level, and great views of the mountains. So it's a great property. Definitely something that you can get more of a professional tenant in here at this time.
Yeah, perfect, Jason. So this is a tool that we use. My background's in accounting and finance, and I build models to help underwrite properties. So for investment properties, this is that property you were talking about. Now it's a duplex, so it has two addresses. You'll see up there the 378 and the 380. You mentioned that a little bit, but it's for sale for 517. These dark cells are the variables. So it's for sale for 517. If the investor puts 20% down, there's nothing to improve. These are new, right? They're not remodeled, they're brand new.
It's a brand new build.
Okay. So there's nothing to upgrade. These are turnkey. Now, based on what you said earlier, Chasen, you guys are a little bit flexible, and we can run this without closing costs from the buyer at that price. Is that correct?
Correct.
Okay, so we're using a loan that's at 7 3/8. Although of course it will depend on the buyer's qualifications and whatnot. But that really doesn't matter. We can put new numbers in if the buyer has a different rate, or if we can get different points or whatever for that loan. But we're assuming 1.5 points down for the non-owner OC loan. So the investor is into this property about $110,000, 109,604, based on these calculations so far.
Right.
Now we're expecting $1,650 per side in that duplex per month in rent. So there's the monthly rent. Yep. I always project going forward, I always project some level of vacancy, because if we're going to project something for the next 10 or 15 or 20 years, occasionally there's going to be an empty month in one of the sides, or both occasionally. So I'm assuming 96% occupancy. This variable just says, what are we doing with the proceeds or the cash flow? Are we using to pay the loan off early or not? In this case, we have that variable set to no. There's the loan rate. There's the loan term, 30 years. Maybe there'd be a way to do a buy down with any concessions. We can work that out at the loan level sometime if that's where the concessions make the most sense, but I'm not showing that in the projection. Annual tax on this property, annual insurance. There's no HOA. The tenants would pay all the utilities. We're putting a percentage of the home as capital expenses and maintenance, so 0.5% of the value of the home. This is a little lower than what you might do on a home that's 50 years old, because it's brand new and it's got more durable construction materials in there. So we're expecting over the long run about 0.5% of the value of the home to be spent on maintenance and capital expenses like water heaters and deductibles for roof repair or something. And then there's any other monthly costs. There's nothing there. This is just sort of a catch-all for costs. And then this is, if you don't have this professionally managed, that's what we're going to look at the numbers for. If you want it professionally managed, we can run new numbers and put in the variables of how that's being charged, and then turn that variable on. So this cash flow is about $50 a month. Now we're recommending setting some aside for maintenance and repairs. That won't be necessary in the beginning because of that it's new, but I just want to project that. And then we're assuming assumptions of 4.5% appreciation here, 3.5% inflation on expenses, 4% rent increase, and a 26.4% marginal tax income rate. The reason I track this is real estate creates a lot of deductions, and the tax rate of the investor determines how valuable deductions are. So that's that rate. This number here is the comparison rate. So if this is a 100 and let's scroll back up. This is about $110,000 investment to get into this property. If we were to invest $110,000 in something that earns 10%, then that yellow piece on this graph is what tracks that. So this graph shows the overall value of my real estate investment. The dark blue is the equity. The white is the cash I put in my pocket. So by year 5, it looks like there's about 200 and something. We've got the numbers over here to the right, excuse me. By year 5, we've got $256,000 of equity. We put $76,864 of free cash flow into the investor's pocket for a total value of the investment of $333 over a 5-year period, which is a 25% annualized rate of return. It's 21 or it's 29%, almost 30 just in the first year between the tax benefits, the equity increase. So this is important because a lot of times people will look at cash flow like it's the only thing that matters, and clearly cash flow matters, but the appreciation is really where most of the return comes from. The combination of appreciation and using leverage, the loans. So within 1 year, we turned $110,000 into $131 of equity, $11,000 of cash between the cash flow and the tax benefits, which creates a 30% annualized rate of return, or 29.85. So that's the overall investment graph. This is the graph of the net monthly income. So it's just creeping up over time. If we switch this variable here to yes, the one that shows what we're doing with the extra cash, then it will show when this property gets paid off. And we can do that if somebody wants to see that. This is just a printout of the report, but we can do another printout showing when it gets paid off. And then these numbers on the right are just snapshots at different points in time. By year 5, this is what you're looking at. By year 10, by year 20. So that's how this calculator and proforma works. And here it is based on this property. Frankly, Pueblo is a great place to invest right now because you're still getting good cash flow with even 20% down. It's really tough to do that in Colorado Springs or Denver or any of the metro areas from those 2 cities. But Pueblo is still pretty nice because you can invest in something with only 20% down, still cash flow.
Well, I also noticed that based on your chart, you see that the cap rate is at 5.87%, which is still a pretty good cap rate too.
Yeah, so there's that figure. That's interesting that you mentioned that. A lot of people misunderstand what cap rate is. So I'll mention it here. I know because we've talked about it, but just for viewers to see, cap rate is just a measurement of income. This just says that based on the value of this property, after expenses, not including the loan, after operating expenses, it produces almost 6% of its value in the form of income, net income every year, net operating income to be very specific. So that's what cap rate is. A lot of times people will associate that with return, and it's not return. It's a different measurement. It's a part of the return, but only the income component.
Right.
So
exactly.
Yeah, this is a good cap. You don't see caps like this in turnkey properties in Denver or Colorado Springs because it's too populated. But out in Pueblo, caps look really good. This is just a measurement of income. So good point.
Yes.
Now this is the calculator itself. It's not a printout. But if we turn the income, if we say, all right, with the extra cash that we're getting from this property, if we put that against the loan, when would it pay itself off with its own cash flow? Now I don't invest tax benefits. So the tax benefits I still count as cash because that's exactly what they are. But I don't reinvest those in the mortgage in this pro forma. I'm just showing with the regular cash flow that this property produces, if that gets reinvested to pay off the loan so that we can get to this amount of cash flow earlier, then we're showing, looks like at 17 years, this property pays itself off with a net cash flow of $5,500 a month. That's a lot of cash flow for this was a 25% down. Let's change that back to 20. So it looks like it pays it off in 19 because we only put 20% down instead of 25. But it pays itself off in 19 years with almost $6,000 of net income, which for a $110,000 investment, that's incredible. That's really good.
Right.
So
exactly.
This is a good property. Yeah, you got to capture. I always think of it in there's 4 elements. There's the appreciation. There's the debt pay down. If there's a debt on the property or a mortgage, that's a form of wealth increase. Then there's the cash flow, and there's also the tax benefits. So you have to add all those things in to get an idea of what your actual rate of return on your money will be, because you're going to get financial benefit in all 4 of those categories.
Right. Exactly.
Anybody watching will see Eric Stegall's information over here. He's one of our lenders down in the Springs. So if you have loan questions on whether you could qualify for something like that, you can reach him there. Of course, reach out to Chasen if you have questions about the property. But yeah, this is about as good as they get from underwriting a property that's turnkey.
Exactly. Turnkey, ready to go. And yeah, let me know if you have any questions. I'd be happy to answer or get you into the property so you can see it.
Thanks, Chasen.
Thanks, Brady.